let's talk about some of the things that has mattered in the past for the S&P 500 on today's Stock Market Brief show. We're going to also go into some of the key levels and market conditions and potential where we might see some rotations if the market starts to sell off. Before we get into today's episode, I want to thank my patrons and then all my supporters who hit that thumbs up, who subscribe to the channel, that like this type of content. If you want to check out the Patreon/Discord, right? You get the Patreon for $16 a month. You sync your Discord up and you get all the benefits. I do want to just quickly talk about something that's launching tomorrow, and that is the alert bot. And this is a creation of my own. I'm just like super ecstatic about it, but it was such a big hit for the daily, weekly, monthly implied moves where you can type in any equity that's optionable and pull up what the market is pricing in for risk. And then also I have the, IVOL premium and discount. Like for example, this is for the SPX right here, if you want to look at those levels. Okay. And you can see that it's trading right now at a 74% premium as the price action has been going to all-time high. So just cool data there. I'm not going to dive too much into, what that means specifically here, but the Asher alert bot now is looking at all the equities that have weekly options and ETFs. So there's like 600 of them. And they're going to push alerts when the upper or lower daily implied moves are tagged, when the weekly implied moves are tagged, whether that's upper, lower, or even 2 sigma, then the monthly levels as well. And you'll get these alerts kind of just letting you know that, hey, for example, today at this time, AT&T hit its lower weekly implied move, or, lower 2 standard deviation move, monthly 2 standard deviation move was tagged for NWS at 29.63 at this time. So just interesting data overall. Remember, I think in terms of probabilities, and if this kind of data will help you, $16 a month, and that's not even written on this of the benefits, right? You still have the community, the weekly, daily, monthly expected moves that I manually do from the options chain, my tight list, my watch list. I post some of the swing trades and all that stuff in there for $16. So check it out if you want to take a look at it. The most you can lose out on is $16. And if you don't want to lose out $16 and you just want to get it for an entire year, you can buy it actually a little bit cheaper than that. Just know that I don't do refunds. So make sure that you like the service before buying it for the entire year. Okay, let's continue on. I want to go ahead now and look at how the markets performed today. They were slightly down. VIX was slightly up, right? Consumer staples led the way and technology was right behind. So a mixed board overall. The prior trading session that was up pretty well. We couldn't get a video out because I was enjoying myself at a Kings game, which they lost, but it was still an exciting game, man. They came back. It's only preseason, but okay. Besides the point, technology led the way, mixed board overall. Yesterday was a pretty light volume day. I will note that I did see this alert come out. The Bureau of Labor Statistics, the BLS, is preparing to release the September CPI report despite the shutdown reported by the New York Times. I don't have the specifics on that, but just be aware that, hey, if that comes out tomorrow, that could rattle markets, positively, negatively, who knows, but it could definitely create some order flow if that drops. If we take a look at the S&P 500 on the daily time frame, we're still within that bull channel. We've been kind of just dragging a little bit higher over here, but we still have that divergence that's currently building. That's a bearish divergence, right? You have a RSI that's higher, then lower, but you have price action that's higher and then higher. So you have just kind of a little internal weakness here. Will it play out to something deeper as far as a pullback? And if so, what do we look for to be ready for a potential next rally, maybe year-end rally, and so forth? Well, I will note that if I look at as far as like a range of risk within these bands, just to the lower range of this band, about 6630, it's only 1.6%. And we've tagged it a couple of times. And from that point, we've actually just rallied from it. So there will come a time where we tag the lower range again. But as it stands right now, it's putting in higher highs, it's putting in higher lows too, something to be aware of. Now, if I add another element and I look at gamma exposure, we do have that big level over here at 6,800. That's known as the call wall. So it's going to be hard for price action to kind of break through that, right? It can reject from here and then also act as more of a pinning mechanism. But you do have traders still continuing to reach out further, let's say 7,000. So if I overlay, some of these key levels on the SPX chart, like I did in the prior video, this is what it looks like. You got 6,800 up here, which is in confluence with the upper band. And then you have this 6,750, which we're currently trading under. Okay, so if we're under this, if we remain under that, that opens the door to 6,700. Under 6,700 opens it up to 6,650, which happens to be the gamma flip line. And that's where things dynamically change in these markets, completely, which I'll talk about once again on another video. We touch it here all the time. So if you subscribe to the channel, which it's free to do, a lot of people watch this show and they don't subscribe. So take a moment, subscribe. Let's carry on. Now, if we can get back above 6750, this opens the gates still 50 points higher to that 6800. If we just take a look here on the weekly implied move for the SPX, it's at 6809, which is in confluence with about that 6800. That's still a possibility over here. As far as the week goes, this was last week's closing price, and we're right there, slightly bid on the week, but overall, we haven't gone anywhere, and yet we still have a wide open range of risk. Remember, 70% of the time, we actually tag one of these weekly implied moves. Now, that's not just me saying 70%. That was the statistics of the entire last quarter, which was 14 trading weeks, and this entire year as well. It even goes back further than that. But yes, so we typically tag one of these. As far as the daily implied moves go that go into tomorrow, we have 6771, and I'm just going to round it to 6700, which is tomorrow's lower daily implied move. The gamma flip line right now is at about 6650. It's kind of think of it as a zone. We're well above that. That's where dealers look to buy the dip, sell the rip. If we start getting below it, that's where volatility can really increase, because you can have dealers, market makers, right? They'll be selling into the selling as far as hedging activity goes, and then buying into the buying, causing much more volatile price swings from an intraday basis and potentially a multi-day basis too. If we take a look at SPY on the 15-minute time frame, we're right there at about that 5-day moving average. We're kind of just doodling around right now, right? So we're just kind of pinned within this little tight range over here. 5-day moving average is flattening out, but we're above the October VWAP. We're above week to date. So if we can hold above that, right, that opens the door to the upper daily implied move for the SPY, which is about 675 to about 676, and then below us, 667 to about 665. That would be that lower daily level to watch. Now, if we do get down there, just remember, that means that the 5-day moving average is going to start to flip a little bit. This is going to flatten out to potentially turn down, and the week to date. So if we get down here, these can act as resistance, and it could just give us a little bit of a warning sign of a potential change in trend. We talked about that in the last video. We were down here, and we said if we can get above this area, it's most likely going to go to its daily implied range, right? It opened the door to that. And look at this, actually, where I marked my marker right here, that was the daily implied range that we talked about before this price action happened. So watch these levels. They're important to the market. They have been important. Let's continue on. If we look at the direction of the 5-day moving average, you're seeing some changes, right? DIA turned red, but it's still overall trending higher. It's just starting to turn here. You have yellow on IWM. It's just saying that, hey, the 5-day moving average is still trending higher, but price action's below it, so it's being cautionary. S&P 500, same situation. Semiconductors have been above a rising 5-day moving average. They've been kind of, under it, a couple of times, but the 5-day moving average has been rising since early September, right? So for over an entire month. So there will obviously come a time where this flattens out, where it turns yellow, where it turns red. That's called a consolidation. It's called a pullback. Going to happen when? Who knows? Maybe in the very near future, maybe not, right? We have earnings coming up for a lot of names and so forth. SMH is, 20% of this name I think is like NVIDIA basically. So it would require some of those to fall. Okay, or consolidate or pullback, right? Now I want to talk about, things that have mattered in the past, right? So one of the charts that I shared on Twitter and I want to share here is this one. This is the total put to call ratio. And to smooth out the data, that purple line, I smooth it out with the 10-period moving average. And one thing that I do is mark the screen at the 0.8. When the 10-day moving average is underneath 0.8, it's just saying that sentiment overall is rather bullish, like bullish extreme. And those are the times that you want to really take your foot off the gas a little bit and be significantly more cautious for conditions to change. And if you look back to the past, right, this could be a little misleading sometimes because it's not always the case. So I'm glad that we have this as, one of the ways that we can share it. But if you take a look back over here, this thing got really frothy at 0.75. And what did the market do? Well, it actually went to go make new all-time highs, but then we actually started reversing out of this to create more of a bearish sentiment. And that happened to be the 2022 bear market. Now, we talked about this. So if you want to go back to my videos when it was like this, when it was over here, we were talking about this. Without a doubt, we were talking about this. Over here, go to the videos when it was underneath this, just whatever this date is, early 2025, right? Go look. And we were talking about this could be a massive, bull trap. Okay. So, and then over here, right? We talked about it over here. And what happened here? It just consolidated. And then we ended up going higher. So the reason why I bring it up again is because we're really close to that level. I don't even know if this is fully loaded actually yet today, but it looks like we're going to cross that 0.8. So it's once again more of an extreme, and this could be a contrarian type indicator, right? Because it's really bullish, markets are bullish, that's great, but also it can be quite contrarian. It's mattered in the past. That's the point. The housing index, the S&P 500 below us, this has mattered in the past. These divergences, I'm not going to, keep on beating this drum. I've shared this, a few times. I share this throughout many different episodes, and even how in 2008, right? 2005, the housing market topped, and then the S&P 500 continued to go higher, diverging. Well, once again, look at, I mean, it took a minus 2.46% today on the housing index. It's getting smothered. S&P 500 is new highs again. So kind of an ominous sign. It's mattered in the past. Will it matter now? Or is it completely different and just won't matter? Prior to this, when the market was actually rising over here, I want to reiterate this, and this was actually going basically straight down. Right at around this time, actually, we basically brought this chart up and said, hey, one of two things are going to happen. The S&P 500 is going to come down, or you're going to catch a big, kind of breath advancement in something like the housing index. And it just so happens the housing index did pick itself up, but it yet is still not made a new high yet like the S&P 500 did. And on the more near term, you can see it's still diverging here as the market continues to press itself higher. If you look at the value line geometric index, this one's also diverging. It's mattered in the past. Think of this as like equal weight. Now it's not too far off to be breaking to new all-time highs, but it hasn't yet. And the S&P 500 has. This is the Nysey-McClellan oscillator. This is a traditional calculation. I've been tracking these divergences. You can go back to all the videos I've talked about them because it's mattered in the past. Internals, right? The oscillator itself are showing lower highs, but yet the market's pressing higher. And it doesn't mean, crash, but you can see all these divergences highlighted, right? Had little sell-off, sometimes big sell-offs, little sell-offs, little sell-offs, little sell-offs, all throughout here, you can just clearly see. But on the flip side of that, you also have bullish divergences. Look at all these green lines down here. That actually marked nice bounces in the market. So right now, what's it showing me? It's showing me still a negative divergence as the market kind of climbs higher. And, I shared this on a prior episode here, and you can see, look at the market, took a little bit of a breath down today, down, it was it was a pretty big bar down from 21,725 to a couple hundred points there. So overall, it's currently diverging still, and it's under that zero marker. Another thing that's mattered in the past is the Nasdaq bullish percent index. I love to look at these diverging as well from the RSI, where the RSI puts in lower highs, and then the reading itself continues higher, just telling that there's a little divergence there. And look at the market's pressing higher, right? And these are diverging. So is this telling us that, hey, yeah, we're pressing higher because some names are bringing us up, but are we nearing the part where this is going to take a little bit of a backseat? Well, it's mattered in the past, right? It's mattered in the past, consolidated, sank off over here, right? Into this little correction, it was about 10%. But then on the flip side, once again, there was bullish divergences that marked bottoms as well in the market, or close bottoms or bounces in the market. I want to get into some other interesting bullish percent charts and kind of walk you through what may be setting up here. First, this right here is the bullish percent index for the consumer discretionary. And the reason why I'm pulling this up is because you can clearly see that we're in an oversold condition on the RSI, actually kind of a positive divergence that's forming here. But there's something important to know about consumer discretionary. It's made up of, really two names, right? So you have, like, if I pull up XLY, the Spider ETF, consumer discretionary ETF, you got Amazon and Tesla. And Amazon and Tesla, if you just look at those, Tesla, right, it's doing very well. It's actually pulling back to the 20 EMA. It looks like it wants to continue this little path up higher, just consolidating its recent pop-up. So, it doesn't look like a bad chart at all. It's above the moving averages. It broke out, some good volume on the move. It looks good. It looks good overall. Amazon, this one hasn't been doing as good, right? It's basically flat on the entire year, but yet it's not like a bearish looking chart really, right? You're basically, you're consolidating here, right? You might be calling this, more of a base consolidation right over here, and it's getting back above some of these key averages. Doesn't look all that bad. So how the heck is this discretionary bullish percent chart falling off a cliff? Well, you have to look at some of the other, discretionary type names. And if we go down some of those names, let's look at them. We'll pull up Home Depot. Home Depot's basically been straight down from 430 down to 377. Okay. So as this is getting very frothy to the downside and it's pressing lower, perhaps as we create these bullish divergences, it might offer up some relief or rotation into some of these names for just a temporary relief. So I would be paying attention to some of these discretionary names that maybe have been getting hammered for just little bounces, right? Or a little bit of relief. So one would be, like, for example, Home Depot. This got underneath the year-to-date VWAP. Sometimes we actually end up floating around the VWAP. So if we break down, maybe come back through it, see a little bit of a pop, or just come right back into it and offers up, a few bucks here, a few bucks there per share on a name that's been sinking off rather hard. It hasn't just been Home Depot. Like, same thing with like Lowe's too. McDonald's, right? This is consumer staple, but it's also in the discretionary sector. Look at this, has been kind of coming off pretty hard and fast, right? It's kind of getting, price action is actually getting rather rather tight over here. So is this going to offer up some relief and retest that year-to-date VWAP too as well? Overall, this thing has been going sideways. It's actually putting in the McDonald's logo, as you can see right here. Lowe's, right? If you pull up Lowe's right here, same thing. It looks just like Home Depot, falling off into the year-to-date VWAP, but pretty much in a straight line down. So a lot of these housing sectors have been kind of getting beaten up. So if you want to, like, screenshot this, look at some of the names, like Starbucks, that's been getting beaten up. Dash actually looks pretty good. TJX actually just reached into its lower implied move for the month. RCL has been kind of backing off of its highs, but it's, still wedging, right? These are things that I know because I look at these names. Ford has actually saw a really nice breakout, and now it's been kind of coming back in these last 3 or 4 trading sessions, but it's still holding up decently. Okay, so yeah, take a look at some of those names and just see what you see, and maybe mark or put them on your watch list and see what happens if the market starts to sell off, if any rotation maybe happens in those names. If we look at consumer staples, these have also been selling off too, and the RSI has been pretty frothy to the downside. So perhaps maybe some relief in some consumer staples names. I will note, if I pull up the top 20 holdings, Walmart, Costco had a bang-in day today. Walmart's near its highs, right? But then if you look down the list at some of these names, like, Target, it's basically at lows for the year to date. I actually took a little bit of profits today on my Target position, but it was a smaller position regardless, because I took it was like a falling wedge, and it popped. It went down and then it popped up a little bit, and I just sold a little bit. We'll see what that does. Like KVUE, I think that saw some movement today. Yeah, and just pull up some of these names, see what you see, and then watch what happens if the market starts to roll over. That means the cap-weighted index are rolling over, but yet there might be rotation into some names that have just been kind of left for dead. Let's take a look at bonds. TLT currently flagging, right? So maybe keep an eye here on TLT. Oil kind of came off a little bit today. Again, 1.84. It's still in that bearish trend. That would be, in my opinion, positive for bonds. Typically, right, if oil goes higher, you'll typically see yields follow, which is bad for bonds. So this, if oil wants to continue to break down, I'd be keeping an eye on bonds. And there's all different types of proxies that you can use. I'm just showing you TLT. The dollar continues to break out higher over here. Pretty strong breakout. I feel like we did a really good job calling the September low and comparing it to the 2017 analog, Trump's first term in office. And it's really following that. And if it continues to follow that, that means we go higher into like November-ish, and then basically it rolls over into next year again before once again going higher. So we'll look at that when it matters. But that big move in the dollar maybe put some pressure back into gold. That correlation's actually been positive, but then on the longer term, it's a little bit negative. Well, today gold was down 1.67%. Obviously, that's going to take place after a run up like this. So, a big move like this, if we get some more, push down, yeah, we might get to a new high pretty soon, but this could be the start of a longer period of consolidation in gold, like we've seen multiple times throughout history. That's all I got for you on today's episode, everybody. Hope it helps out, gives you some insight into these markets. Do your best to manage risk. Focus on the 4 things that you control, and that's what you buy, when you buy it, how much you buy it, and when you sell it. I'll see you on the next episode.